All right. Welcome to the show, TSP Weekly Podcast. The only place that you can find two old guys sit around and talk about TSP for hours and hours.
I think there are going to be more old guys looking at TSP here in the coming weeks and months.
Well, I hope with all the stuff we do that we have more people looking at their TSP. I know at least people that I talk to, once they figure out what we do and everything, even if they don't follow our stuff, they pay more attention because I'm like, this is your retirement. Like, but I kind of get it. I mean, I didn't pay attention early on, but if you're our age or if you're in your mid-career and you're not paying attention to your retirement account, whether it's TSP or 401k, man, you can't put your head in the sand, especially times like this, which I know we're going to get into.
Yep,
so
we are going to get into
rock and roll.
It's been a heck of a week
this week.
Let's see what we got. So, okay, all right. So let's take a look at what we get this week. So TSP Weekly Podcast, 23 November 2025. So we'll take a look at a couple of the economic highlights. We're still trying to get backfilled with the data due to the government shutdown, and that is going to be pretty interesting because the Fed's not going to have another jobs report before the next Fed meeting in December. So the market is kind of flailing around a little bit about that. Nvidia really was the key for the week so far, and we're going to talk about that. We'll look at what Thursday's market action actually looked like on a chart, and then we'll do the weekly versus daily charts because really you got to keep all this in perspective, and the weekly perspective is much different than the daily perspective right now. So September jobs report, right? We didn't get one for a month, and it was causing a lot of consternation because nobody knew. We had in August, the revised number was a 4,000 job loss in the month. As opposed to creating new jobs, we actually decreased 4,000 jobs in August, and that had everybody kind of riled up. Because if we're losing jobs, it means the Fed's going to cut rates, the economy's falling off a cliff, and that's why the expectation of a December Fed rate cut was really high, but it was unknown going forward because of the shutdown. So we got the numbers this week, and it showed an increase of 119,000 jobs for September versus the 4,000 that were lost in August. So that 119,000 was much bigger than what people expected. And what that does is it puts in doubt whether or not the Fed is going to continue cutting rates. And the rate cuts is like the fuel for this rally to continue. So if for whatever reason the Fed decides not to cut rates, it's a problem for the market. So that was definitely a big part of Thursday's kind of sell-off. We get initial jobless claims that rose to 224,000 from 219,000 the week before. That number is a little bit squishy also because we hadn't had weekly numbers because of the shutdown. But 224,000 isn't very much. It's not like a lot of people. There's a lot of talk in the media about a lot of job losses, and I'm sure they're happening, but it's not following through yet in the official data. Unemployment rate did rise to 4.4% from 4.3%. But again, that's not a huge move to the upside. So all that is basically saying that the Fed is still on the fence about whether or not to cut rates. The 3-month and 6-month bond auctions both sold for a little bit higher yield than they did in the prior auctions. That's not good. It adds to the deficit. And we get the Fed meeting in December. So it's going to be really interesting between now and then. And all this lack of knowledge, basically lack of stability, causes volatility. And that's what we're seeing in both directions. This is the most.
I wanted to jump on that. I've been doing a little research, because I didn't feel like, 20 years ago we were talking about the Fed so much, right?
We weren't.
And I started going back and looking, I went back to like 30 years, and it definitely has changed since 2008. And I started trying to look at things, why, and it starts to make sense. I mean, I think, with obviously the internet, right, and social media and things, have the amount of information that we get now is just astronomically more than it was 20 years ago, especially 30 years ago. But particularly after 2008, I started noticing that because we have so much algorithmic trading now, right, that you would think that it would, so it responds so much faster now because there's less humans involved. There's a lot of machines going on, and a lot of people don't realize that, right? They think that it's people turning these knobs, and yeah, in some cases it is. A person has to do all that set up all that algorithmic trading. But anyway, you throw in all the machine stuff going on, right? As far as people, you would think that would take more emotion out of it, but it actually, because the Fed has become so much more transparent, all this data is out there that we wouldn't normally have such quick access to, that has started making it more volatile. Like it's like we've gotten addicted to the noise from the Fed. I mean, it's just like crack. Like and you would never see this stuff happen. And so it's almost like I wish they would dial it down a little bit. You know what I mean? I don't necessarily want us to, I like the transparency, but dialing down the hype a little bit, because it's only making it worse. And I think a personal opinion, not necessarily ours, is that's what's causing a lot of this.
Yeah. Things have definitely changed since 2008 in terms of the Fed. I mean, where we are right now, the market is so overvalued. If the Fed and or the Treasury, because it's a combination of the two, but if liquidity doesn't continue to pump into the market, stocks are going to fall, because that's what's holding the whole thing up.
Right.
And there's the passive bid, right? We've talked about that quite a bit. If all the 401k money, it doesn't matter what the price is. If every 2 weeks you're contributing to the C fund, you're buying, you're contributing to those 500 companies. And now I got a slide we're going to show. 20% of the S&P 500 is 3 companies. 20%, that's 19.96%.
Yeah, that's absurd. Now, I will say that, I don't know, I'm kind of getting off track here, but I think just these things that are going through my head that I think a lot of people are talking about right now. And you just see this AI bubble term used all the time, right? And like we say with a lot of things, I think we have to keep all this stuff in perspective, that this is not the .com bubble.
Nope.
Because the companies that were back then, a lot of them were not real companies. They weren't, they didn't have the foundations that these companies do. Nvidia is not going to disappear.
No.
Right? It's just not going anywhere. Microsoft's not going anywhere. Does Claude win over ChatGPT or Gemini? Who knows, right? But Google's not going anywhere.
Nope.
Right? So there's a bubble, but it's a different kind of bubble. And I think that just needs to be in perspective, that it's not the same, even though it feels, so people are, I think, scareder than they need to be. It's kind of where I'm going.
Yeah. I mean, it's possible. It's just that it's so concentrated that if any bobble happens, there were some articles that came out, when the market gapped up on Thursday, there were some articles on CNBC talking about how Nvidia just saved the AI bubble popping narrative, because they had huge earnings, right? And yeah, it did. It saved it for about an hour and a half.
Yeah, that's why I was laughing. I was like, yeah, it saved it for a little bit, but yeah. All right, I took you off track. Let's get back to the jobless claims.
Yeah, I mean, we'll get past this stuff, but just the jobless claims had been coming down, right? And the 200, I can't remember the number now, but the 224 or something, basically we're actually up here. This was last week's at 219. And so the downtrend was basically broken this week. And that's what's got everybody kind of concerned, because if the jobless claims aren't, if the jobless claims start to go up significantly, then that helps the Fed cut rates. But as long as this is declining, the Fed's less likely to cut rates. And it's all about cutting rates, adding liquidity to the system. They stopped quantitative tightening a couple of weeks ago, and a lot of people think that they're going to start back up with quantitative easing, meaning it's just different terms for ways to push money into the system, because the system needs it. When the economy is rolling over, the only way the market gets more money is if the government basically pumps it in. And the Fed can't do it if it's the balancing act, right? I would hate to be in the Fed right now. I can't even imagine. So Nvidia is really the kind of one of the biggest stories for the week. You got Nvidia stock fell along with the broader market on Thursday, despite the chip maker posting better than expected third quarter earnings and providing a strong outlook for the current quarter the day earlier, right when it came out on Wednesday. So shares of Nvidia closed out the trading day down 3.15%, turning higher at the start of the day. Well, that briefly turning higher was up over 5%. So the swing was like 8 or 9% from the high to the low for Nvidia on the day. And then the company's Magnificent Seven compatriots also fell on the day. So this is what Nvidia looked like on a 1 hour chart. Okay. That was the open, and it had broken the downtrend line, right? So as soon as it broke that downtrend line, everybody's piling in because now it's going higher. And we got this little consolidation right here, and then it rolled right over and collapsed all the way down. And basically this is where we closed on the day. I mean, it was a huge...
And everybody's running.
Yeah. Yeah. I don't know what happened. I don't know if Nvidia rolling over caused the market to roll over, or the market rolled over and then Nvidia, or it's just an algorithm and you can't tell the difference. I mean, in reality, Nvidia, before this 3% correction on Thursday, Nvidia was 8% of the S&P 500. Now it's like 7.3% or something. I have it on a slide. But as goes Nvidia, so goes the market, right? These are the three companies I was talking about that make up 20%. If you add the weighting of the S&P 500, you add that up, it's 19.96%. So basically 20% of the entire S&P 500 is made up of three companies. And Nvidia was 8% until this 3% price decline, so that takes off some of the market cap. But three companies making up 20% of the S&P 500. If there's any bobble in those three companies, the market's in trouble. It's just so concentrated. It's not good. So Thursday for the S&P 500, right? This is a 10-minute chart. Okay, you can look at different charts on different time frames, and they tell you a lot, especially where the support and resistance levels are when things roll over. And so this is 67.70 roughly, like the middle of that channel. So I drew that support and resistance channel. So we gapped up here. This is the 24th of October. We gapped up here, right? This is the S&P. Price moved up, came down, hit support at that level, rallied a little bit, came down, churned, and then broke through to the downside, right? Comes up, now it's resistance. Comes down, and now it gapped above it. Great. So we're back. Now it's support. Awesome. We're off and running again. Comes down, can't get above it, comes down. This big move that we had at the open was like the 1.5% gap up at the open. And it churned for a little bit right at that support and resistance zone. But it was like it hit a brick wall and rolled right over. So clearly that 67.70 level is going to have to get taken out to the upside before this rally is able to continue. There's going to be a lot of other, support and resistance levels along the way, but eventually that 67.70 number is going to be important. And we can see a little bit different on the weekly versus the daily charts. So I'm doing the weekly chart first, but so to kind of put a broad perspective on this, right? Each one of these ticks is 1 week of price movement. So if we forget about all the craziness that happened this week, each one of these is 1 week of price movement, and this is the 20-week moving average line. So here's the beginning of 2024. We had several times when price came down and hit that 20-week moving average line, right? And then each time it did that, we went on to make new highs, okay, until it finally broke through, and then we had that move down in April. Since we recovered from that April low, this is the first time we've tested that 20-week moving average line, right? Here we are today, for Friday, testing that 20-week moving average line. So is it possible that we get something like this? This was the first move off of this correction, right? It came down, hit that 20-week moving average line, and then the next week picked it right back up, and we went on to new highs. Is it possible that happens this time? Absolutely, it's possible, right? So if you're only looking at weekly charts, you're at a decision point, basically. Not really a decision point right now, but it's at support, right? If it finds support and goes higher, that's great. The trend continues. If it breaks down through that line, risk just went up a lot, right? Because now are we looking at something like this, or that? So it remains to be seen yet, right? On a weekly basis. If you look at it on a daily basis, it's a much different kind of picture, right? It just looks different. This looks like the trend is still going up, right? This one looks like it's rolling over. And the biggest thing is, once we got this bottom here in April, right? We came up, we put in a high. This low was higher than this low. Then once we got back above this high up here, now we have a higher high and a higher low. So now we have an uptrend, and it kept on going that way. This high is higher than this one. This high is higher than this one, right? It just keeps on going. What we have right now is we had a high. We got a pullback. It stayed above this high, which is fine. But then when it recovered, it's lower than this one. Okay, so that's the first red flag. You have a lower high. The second red flag is now, as of Thursday's close, we have a lower low. Okay, so we have, on a short-term basis, a trend change. You could also look at it like it's gonna go sideways. We could certainly have some kind of sideways consolidation here that ultimately breaks to the upside. Because as we always say, it can either go up, down, or sideways. So if we do get support in here somewhere, the market can do this for a while. If it breaks down significantly, one more big down day, and it's going to start looking like a waterfall. So all I'm trying to say is the perspective on a daily basis is much different than the perspective on a weekly basis. And this is just a time when people need to look at it and think about making a decision.
Right.
The trend that has been in place since that April bottom has changed.
Right. That's the clearest way to put it. The trend has changed. How long that trend will continue to be, nobody knows. We can't guess that. We're not going to, there's no crystal ball, as we say.
Yep.
However, you are at a decision point because as the risk, right now it's kind of, we're on the bubble, right?
Right.
If you're looking, just as you just explained it. Next week will tell us.
Yeah.
Right? It will tell us one way or the other. I mean, it might go sideways, as you said. And, a lot of people, I think we both listen to a lot of the same people, but a lot of the people I'm listening to are like expecting this sideways correction. And an upswing after that based on a lot of the things that you repeat every week, right? Where seasonal is on our side right now. Santa Claus rally time is coming.
Yep.
On and on and on and on, right? But who knows what the Fed does? And then, like we were talking about in the beginning, the Fed drives a lot now where it maybe didn't used to. And, the more that you start to accept that a lot of this is algorithmic trading, nowadays, and that's not new, but there's just so much of it, and there's so many people trading, more as retail investors and such. So I just feel like that's having an impact on the volatility. And we're just so much hype right now too with the AI. I mean, every day there's something else coming out that's, world changing, life changing. And it's just like, I think we just need to tone down the noise a little. That's not going to happen.
Yeah.
They're not going to tone it down.
Yeah.
But I think that's driving a lot of this. There's just so much angst and anxiety. But like Jerry said, pull back a little bit, that'll help. Because I do spend most of my time, right, looking at weekly and monthly.
Yep.
I mean, this is a long-term game, right? This is 20, 30 years retirement accounts. And, for us who being semi-retired, retired from the government anyway, we still got another 20, 30 years, right? It's not over.
Yeah, let's hope so.
So we're still in the game, and a lot of people, if you're truly going to retire and go off and go fish or something, whatever you do, and you need to live off of it, that's a little different, right? But if you continue on, anyway, we say these things a lot though. And if you guys are new to the podcast or if you've been watching it for a while, like, you got to keep all this stuff in perspective. Don't get pulled in so day-to-day kind of nonsense and chaos, and watch the show.
Yeah. I don't know how I say this all the time, but I have no idea how people can get their mind around the direction of things without putting at least some basic lines on a price chart.
If they don't, they're living in chaos, all the time. And it's almost become a reality TV show, the market. It's amazing how much attention we pay, the average person pays to it now, because they don't have a choice, right? It's all over the news, whether you're watching financial news or not, right? You're still going to hear the normal newscasters talk about Nvidia, Thursday and all, they're going to talk about it. So then it just makes people scared because they don't really understand what it means. And like you said, if you just take, a little time, learn how to just look at a simple price chart and go, okay, well, yeah, this big thing happened this week, but like what really changed? Nothing yet.
Not yet.
Nope. The trend changed, but it could just as easily change next week again, right? So just be paying attention. I think that's the biggest takeaway. And if you guys have any questions, we love questions. We talk about them on the podcast. So if you see this video in Facebook or social media or YouTube, whatever, just comment section, throw us a question or a comment. We love to hear from you. If there is no comment section, you can always send us an email at support@growmytsb.com.
Alrighty. That is all I got.
Any closing thoughts for us?
I think the volatility is going to continue.
It's not going to be calm for a while.
No. This is going to be the new normal for a while.
We've been saying that for a year.
Yeah.
I think.
Yeah. Well, it's funny because a lot of people still refer to like trying to get back to the way things were pre-COVID, as if that was the normal. And we're not going back there.
No, that's gone. Yeah, this is the new normal.
Yeah.
That's what you got to accept, this is the new normal. All right, guys. Well, I hope you guys have a great weekend, and we will see you next time.